Participants has a
Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Press Cooper. Today I've been joined by my colleague Mahar Afzal, who is the managing partner, and together we will take you through today's webinar. So as I mentioned last week, that FTA has been introducing a lot of guides to give a better understanding of the corporate tax provision, to give you an in-depth view of various provisions and the documentation compliance required for them. So we've already seen that a general guide had come out, transfer pricing guide has come out. There was a guide on the taxation of natural person. Then there was a guide we discussed last week for the extractive, non-extractive natural resource businesses. And today we will be discussing a guide on tax grouping. So if you've missed any of our lectures on these guides, which we have already done, you can go to our YouTube channel. And if you have any questions about those webinars, you can always email us at info@crestcooper.com. So today I will be recapping the guide that we discussed last week, which was for entities who are engaged in extractive and non-extractive natural resource businesses. So under the corporate tax law, there are certain people who enjoy the exempt person status. So one of these from this list of people, the businesses which are engaged, the entities which are engaged in the extractive and non-extractive business are also part of exempt person list. So these are the people who we will be discussing today and the taxation relating to them. So, like we said, we discussed this guide last week. It is a very comprehensive guide. It tells you about, which reliefs are available, what to do about the extractive business, what is, natural resources, how to deal with the taxation, how to get the exemption. So it's a very detailed guide, and I will give you a snapshot of this guide right now for the recap. And if you want to see a detailed lecture on it, you can see our lecture from last week. So under the corporate tax law, the natural resource, what does it include? Water, gas, oil, coal, any other non-renewable natural resources, they're all part of natural resources for corporate tax. But renewable resources such as solar energy, wind, animal, plant materials, they are not counted as natural resources. Now, natural resources under the UAE constitution are basically considered the property of the Emirates, and that is why they are taxed at Emirates level and not at the federal level. What is the difference between extractive business and non-extractive business? Now, extractive business basically includes exploring, extracting, removing, or utilizing any natural resources. And the non-extractive natural resource business, basically, it involves separating, treating, or refining processes, storing, or transporting, marketing, distributing these resources. And all these activities, we can club them into, broadly into upstream business, downstream business, and midstream business. Upstream business from these, they basically are the companies who are engaged in extraction of the natural resources. The downstream businesses are the one who are doing the marketing and the distribution of these products. And midstream business is basically the business, the processes which are a link between the upstream and the downstream business. So basically, they include like transportation and storage. So to get this exemption for the natural resource business, the first condition is that you need to have a right or a concession or a license from a relevant Emirates, because that is required, the first condition. And then you need to be taxed at the Emirates level. Like I said, that for these kind of companies, they are taxed at Emirates level, not at the federal level, and you need to have notified the ministry of this. So these are some of the conditions. Now, one of the extra conditions for non-extractive natural resource businesses also that the income you should be generating from this business should be from the entities which are also doing a business in this activity. They cannot be end consumers. Otherwise, you will not qualify for this exemption. Even if there's a single transaction which is being done with these kind of end users, then you will not meet the qualifications. This is an extra condition for non-extractive natural resource business. So if a company is involved in the extraction of this natural resource business, they can have another participant, but the condition is that both the participant need to have this license, which is the primary condition to have the right concession or license from relevant emirate. And if these natural resource companies and the extractive business are, subcontracting their business, a part of their business, to somebody else, for example, to a contractor, subcontractor, like for drilling, for example, on their site, so they will not be considered as exempt person. Only the people who have the license who are engaged in this extractive, non-extractive natural resource business will be considered as exempt people. So now, a company who is engaged in the extractive or non-extractive business, they might be engaged in other business activities as well. So how would you separate that which transaction pertain to the natural resource business and which pertain to the other business? So the broad category of how you can follow is that if any transaction is done, relates to a business activity that is done under this license or right or concession which is issued by this local government, then it will fall for the extractive business under the extractive business. But if it is done under some other trade license, then it will not be part of that business, but of the other business. Now, if a person is basically engaged in the extractive, non-extractive business, but also has, driving income from a business, which is ancillary or incidental business, and that business does not exceed 5% of the total revenue of the overall revenue of that person, then that can be disregarded for corporate tax purpose. Now, what is ancillary business? Any business which is necessary for the performance of the main activity, which is so closely related to the activity that it cannot be considered as a separate business, that would form part of ancillary business. Example could be like selling waste products which are generated by oil and gas production. Incidental business, on the other hand, are the infrequent, activities or which are generate secondary source of income. Example like occasional sale of surplus equipment or interest on excess fund invested. So if these activities that can fall under ancillary and incidental, and they do not exceed the 5% of the total revenue, then they will be disregarded. Otherwise, they will be considered as other business and they will be subject to the corporate tax. Now, some of the compliance requirement that we have, record keeping. So if you have exemption because you will need to prove to FTA maybe that about the exemption status. So you need to have those records, which are ascertaining this exemption status for at least 7 years since the exemption is claimed for any exempt person. For tax registration, if you are part of the natural resource or the extractive, a non-extractive natural resource business, then you're only doing solely that business, you don't need to register. But if you're doing another business and that is not an ancillary or an incidental business, or that is ancillary and incidental, but it is more than 5% of the total revenue, then that you need to register that business because it will be considered separate business. You also need to have financial statements separately for those businesses. For the tax return, again, for the other businesses which is qualifying as a separate business, you need to file a tax return within 9 months. Now, there could be a situation where because, the incidental business, the ancillary business was more than 5% threshold, that is why you needed to, register it. And then later on, you come under the threshold, so that doesn't exempt you from deregister. It doesn't require you to deregister. You will still have the registration. You only will need to file a nil return in that case. So there are certain reliefs that are given under the corporate tax law, and then some of them are not available for exempt person. For example, the qualifying group relief, because the condition there is that transfer and the transferee, they should not be exempt person. There's business restructuring relief. There again, the condition is that both the transfer and transferee should not be an exempt person. So transfer of tax loss, both the persons should not be exempt person who is transferring the loss and who's receiving it. The tax group condition, again, the member of the tax group cannot be an exempt person. Exempt person cannot be qualifying free zone person. For small business relief, if your other business is being subjected to corporate tax separately, and then it will be, you can separately look at it that if small business relief is applying to it or not. So basically, since the entities who are doing the extractive business and having income from the non-extractive natural resource business, they are exempt persons, so all these conditions will apply to them. Now I will hand it over to Mahar, who will take you through the topic of the today. Yes, Mahar, you can take it from here.
That's fine. Thank you very much. Thank you. Hello, everyone. Thank you very much. Thank you very much, Faiza, for recapping a previous lecture. And today we are discussing UE, how to set up the tax group for UE corporate tax purposes. And in this, we are discussing primarily the condition to set up the tax group. In our coming lectures, we'll be discussing the rest of the all matters as well. But our primary focus, as I mentioned, will be focusing on the condition to set up the tax group. And you know, the Federal Tax Authority, they have already issued one tax guide related to this tax guide is primarily focusing on the tax group. This guide offers detailed explanation of various aspects of the tax group. This guide addresses the conditions for establishing a tax group, among all other things as well. So we know this, once the tax group is being set up, then the entities will be able to submit, the group will be able to submit only one tax return. And the rest of the members will be jointly and severally liable for the corporate tax responsibilities. Administrative work will come down for sure, because every entity will not be required to submit the return. Only one return will be submitted. And there are some conditions to this. The primary condition is that the taxable persons, they are the resident juridical person. This is the first condition. A resident juridical person. This is the first condition. Second condition is the parent company hold 95%. 95%, there are four things. One is the share capital. Second is the voting right. Third is 95% share entitlement in the profit. And fourth thing is 95% entitlement in the net assets. These are the four conditions, and all these four conditions needs to be fulfilled. The primary condition is potential taxable person must be a resident juridical person. Second condition is the parent company must be holding these four: share capital, voting rights, profits, and share in the net assets at least 95% directly or indirectly. Fourth condition is the potential taxable person should not be exempt or qualifying free zone person. This is the fourth condition. Fifth condition is they have the same financial year. Parent company and subsidiary, the financial year is the same. The financial year is being ended on the same date. And the last condition is that, sorry. And the last condition is all the group members, they are applying uniform accounting standards to prepare the financial statement. These are the all conditions. If these all conditions are being fulfilled, then we can say the person can become a taxable person. Now we can discuss all these conditions one by one. I will go to straightforward to the guide. If we are going to the guide, would be in a better position to discuss all these things in detail. So let's go through the guide. And in the guide, we'll discuss all these things one by one. Okay, in the guide, if you are going in the beginning of the guide, this is a guide for the tax group that has already been issued by the Federal Tax Authority. This is introduction. What is the tax group condition to set up the tax group? We will discuss bullet number 4 today, point number 4 today. We'll discuss the remaining all these points we'll be discussing in our coming webinars. And then this point number 4 is condition to set up the tax group. And for this condition to set up the tax group, condition to form a tax group. We have already discussed then what are the conditions. Parent company and each subsidiary are juridical and resident person. First is the juridical person, second is the resident person, 90% share in the profit, 95% share in the voting rights, 95% entitlement of the profit, and 95% share in the net assets. None of them is a qualifying free zone person and none of them is a exempt person. Same financial year and uniform or same accounting standard. These are the major conditions. So then they can form a tax group. To form the tax group, parent and the related subsidiaries, they need to file one joint application to the Federal Tax Authority, FTA. Once this application will be approved, then they will be considered they are part of the tax group. A tax group will be effective from the start of the respective tax period or any other date specified by the FTA, but generally this tax group will be effective from the start of the tax period. An important thing is all these conditions, whatever we have discussed, all these conditions must be met continuously throughout the year. If at any time any of the one condition even is not being met, then it will be assumed that the tax group has no existence from the start of the respective tax period. So these all conditions must be met continuously throughout the year. It has been mentioned here as well. The tax group to exist, the parent company and all subsidiaries must meet all the above conditions continuously throughout the year. Then they continue to exist in the fall. If any conditions are not being met, the tax group will be discontinued from the start of the respective tax period, and it will not be a tax group during that tax period. But from the beginning of the next tax period, if all the respective conditions are being fulfilled, then again tax group can be set up, and there is no limit for the number of members of the tax group. They are mentioned here. There are no limit for the members of the tax group. So this is the basically condition to set up the tax group. And now the juridical person. For the juridical person, this is very important. If you can remember, we have discussed one slide in the very beginning. We said there are three different types of person. One are the exempt persons, outer scope persons, and third we have discussed these are the taxable person. In the taxable person, we have discussed two further categories. These two categories was resident taxable person and non-resident taxable person. In the resident taxable person, we have discussed three further categories. One are the company's juridical person which are being controlled and managed from the UAE. These will be the resident person. Second, we said the juridical person which are registered out of the UAE, but these are being controlled and managed from the UAE. It will be considered resident person. Third, we have discussed the natural person who are acting as a business. These natural persons are not juridical persons. The natural person is gone. The remaining are two categories only. If the companies are within the UAE, these companies are juridical person and controlled and managed within the UAE. And second, the juridical person which is out of the UAE but controlled and managed within the UAE. These two categories can form a tax group. Other than these two categories, none of the company can become a part of the tax group. I'm repeating. Might be I will be able to show you the slide as well. That will be very helpful for you. Let me open it quickly if I can find for you. Presentation might be shared. Corporate tax studies presentation, employee master presentation. Okay. Okay, you can might be you will be able to remember this slide. Okay, in this slide, we discussed there are three types of persons: exempt persons, out of scope persons, and taxable person. In the taxable person, we discussed three further categories. These three categories that were discussed, these three categories are juridical person incorporated within the UAE, these three categories. So juridical persons incorporated in the UAE, these are the resident person, juridical person incorporated out of the UAE but controlled and managed from the UAE, these are the juridical resident person. Then it was the third one, natural person, which are being controlled, which are doing business within the UAE. These were the resident taxable person. In these resident taxable person, tax group says the only juridical resident person can become a part of the tax group. This is a natural person. This is not a juridical person. So this is the combination. This combination can become a part of the tax group. Any other entity cannot become a part of the tax group. Resident juridical person. And there are two categories of resident juridical persons. Companies registered within the UAE, companies registered out of the UAE but controlled and managed from the UAE, and these are not qualifying for each one person. These are not exempt persons. These are the only categories of businesses which can become part of the tax group. So coming back to the coming back to the guide issued by the Federal Tax Authority, we said resident juridical person can become a part of the tax group. Now we are very clear that what can be the resident juridical person which can become a part of the tax group. We have discussed this. These are the basically companies registered within the UAE or company registered out of the UAE, controlled and managed from the UAE. These are not qualified and all other conditions are being fulfilled. So these are the juridical persons that become a part of the tax group. So sole establishment, natural persons, or unincorporated partnership cannot become a part of the tax group. For the unincorporated partnership, I have highlighted this here because the individual member ultimately are responsible for the partnership, and there is no difference in between the individual member and the partnership. There is an option for the individual member. They can apply to the FTA. They can ask FTA that this partnership needs to be treated as a taxable person. Even this unincorporated partnership, they have made a request to the FTA, and FTA has treated as a taxable person. Still, this partnership cannot become a part of the tax group. It has been clarified by the FTA in the guide. So resident person, we have already discussed what are the resident person condition. Resident juridical person incorporated, otherwise they said incorporated, other established, recognized under the applicable legislation of the UAE, established under the applicable legislation, foreign jurisdiction. These are same two conditions that we already discussed. Registered within the UAE, registered out of the UAE but controlled and managed from the UAE. So it will fall under the resident juridical person. So under the corporate tax law, for the double tax, there is a possibility one person is a resident at in two different jurisdictions. There is a possibility that one person is a resident in two different jurisdictions. So important thing, if the double tax treaty exists between these two jurisdictions, then based upon this double tax treaty, we need to assess the person is the resident person of which jurisdiction. If based upon the double tax treaty, if the person is a resident of the UAE, then the person can become a part of the tax group. If the person is not a resident of the UAE, then the person cannot become a part of the tax group. This is important. Then there is a possibility that double tax treaty is not existing between these two territories. If the double tax treaty is not existing, they said then the person will be considered taxable in the UAE, taxable in any other, resident in the UAE, resident in any other jurisdiction as well. That person can become a part of the tax group as well. Third thing they have discussed, the person is a resident of the foreign jurisdiction, but during the year they become a resident of the UAE, then it will be assumed that will be taxable from the start of the respective tax period. And if the person is a resident of the UAE and during the tax period, the person will, due to some reason, is not remaining as a resident of the UAE, then it will be considered non-resident. It will be considered not part of tax group from the start of the respective tax period. So this has been mentioned here. You can go through this dual residency, whether dual resident can become a member of the tax group, dual residency, tax residence of the UAE only. If the person is a tax resident of the UAE only, yes, the person can become a part of the tax group. If the non-tax resident of foreign jurisdiction, then the person cannot be a form of the tax group. Subsequently, as a treated for the foreign jurisdiction, subsequently dual resident, but subsequently, if the dual person qualified as a member of a tax group in earlier tax period was subsequently treated as a non-tax resident of foreign jurisdiction. Initially was a resident of the UAE, but later on the person was not the resident of the UAE, then it will be that the person ceases to become a member of the tax group from the beginning of the respective tax period that we have already discussed. Dual residency. So double taxation agreement has the mutual agreement procedure, a tiebreaker rule. So basically the objective and conditions are same. Based upon this tax treaty, the person is resident of the UAE, yes. If resident of the UAE, taxable in the UAE. Non-resident of the UAE, not become a part of the tax group. The same thing they mentioned, person is resident for both country, resident for both countries, then it can become a part of the tax group as well. Third country, the person is treated as a tax resident for both countries. Okay, resident, this is they mentioned, saying no double tax agreement. I mentioned there no double tax agreement, then the person can still become a part of a tax group. They mentioned only if there is an inapplicable double tax agreement, the resident person would still be eligible to join the tax group if all other conditions are being fulfilled. So important thing is we need to look into this double tax treaty exist between the two countries, yes or no. Based upon the double tax treaty, if the person is a resident of the UAE, person can become a part of the tax group if all other conditions are being fulfilled. If the person or if the double tax treaty doesn't exist between the respective countries, still the person can become a part of the tax group if all other conditions are being fulfilled. There are two possibilities where the person can become a part of the tax group if the double tax treaty exists or double tax treaty doesn't exist. But there is a change during the year we have already discussed. The change will be effective from the start of the respective tax period. So what are the documents required to prove that you are a resident of the UAE? Then you need to arrange a certificate from the foreign jurisdiction respective tax authority. They need to make sure that they need to give a confirmation the person is a resident of the respective tax jurisdiction. If you are not proving that you are a resident of the respective tax jurisdiction, your foreign tax jurisdiction, then loss is basically it will be assumed you are a non-resident for the UAE. It has been given in this guide as well. Confirmation by the relevant tax authority, confirmation by the relevant competent authority is unable to prove it, it will be assumed that you are a non-tax resident in the foreign, you are not a tax resident in the foreign jurisdiction. Sorry, it will be assumed that you are a non-resident, not tax resident in the respective foreign jurisdiction if you are not getting confirmation from the respective foreign tax authorities or competent authorities. So these are the conditions. Basically, we will discuss the first condition. First condition, resident juridical person. Resident juridical person. And these companies registered within the UAE, companies registered out of the UAE, controlled and managed from the UAE. These are the resident companies. If all these conditions are being fulfilled, they can become part of the tax group. Natural persons, sole establishment, freelancers, unincorporated partnership, they cannot become a part of the tax group. Qualifying free zone person cannot become a part of the tax group. Exempt person cannot become a part of the tax group. So these are the resident juridical person. If fulfilling all respective conditions, they can become a part of the tax group. Now, second condition, 95%, four condition, 95% shareholding, voting rights, entitlement in the profit, and fourth condition is in the net asset. If all these four conditions must be met, all four conditions must be met. So you can say there's the one company, this company is out of the UAE, this company, once the company is registered out of the UAE, I'm assuming this company is not being controlled and managed from the UAE. So it will be considered non-resident company. This non-resident company cannot become a part of the tax group, but this is a subsidiary within the UAE company E, company owning company A, B, C. Yes, these entities can become a part of the tax group. So these four entities can become a part of the tax group. So C, A, B, so these can become a part of the tax group. But F cannot become a part of the tax group. And what is the reason for this? The important thing is the reason for this is F is a non-resident. F is a non-resident. F is a non-resident. So F cannot become a part of the tax group. Other than F, all other entities can become a part of the tax group. Okay. So company F incorporated and tax resident of a foreign country hold 100% of the share capital of company E, which in turn hold 100% of share capital of company A, B and C. A, B, C, E are incorporated and resident in the UAE for corporate tax purposes. All other conditions to form a tax group are met. Company as a parent company can make an application together with the A, B and C. Yes. E can make an application with A, B, C. E can become a part of the tax group. F cannot become a part of the tax group. The reason is F is a non-resident company. Share capital ownership condition. Then ownership condition 95%, as I said, 95% of the nominal value of the share issued or paid up capital. I am repeating 95% 95% of the nominal value of the issued or paid up capital. So authorized capital is not important. Number of shares are not important. Two things. I'm repeating 95% of the nominal value of the issued or paid up capital. Authorized capital is irrelevant for this discussion. Number of shares are irrelevant for this discussion. This is very important. So if you are going to a 95% share capital, they have defined share capital can be classified into issued, paid up, authorized membership, where your number of shares are not given, then you need to ascertain based upon the value. These share capital, including ordinary share, preference share, redeemable share, does not include that in authorized. Authorized capital is irrelevant. 95% of the nominal value of the share capital, it should be paid up or issued share capital. Then you determine reference to a different metric. Okay, if this is number of shares are not given, then we need to ascertain based upon the value. This is same thing. Ownership of the share capital, you are the legal owner of the share capital. If you are not the legal owner of the share capital, then it will not be considered that you are holding share capital. You must be a legal owner. If you are the beneficiary, it will not be assumed that you are owner of the share capital. You must be a legal owner of the share capital. The share capital ownership is not met if a person is mentioned. If you are the beneficiary, then it will not be assumed that you are holding the share capital. Company A, B, C. So A, agreement to transfer between. So A, agreement to transfer economic benefits ownership. B, share. Basically here, what C is holding in B 20%, A is holding in B 80%. If C is the legal owners of the share capital and C is transferring 20% beneficial rights to A, not the legal rights, beneficial. They are not, basically C is not transferring the share to A, but C is transferring the beneficial rights to A only. It has been very clearly mentioned here. After the transfer, company owns 80% of the shares in company B outright and 20% as the economic owner. Economic owner or beneficial owner. However, the share capital ownership condition is determined based upon the legal ownership of the shares and not based upon the effective ownership. As company A legally owns 80% in B and the share capital ownership condition is not met, as I mentioned earlier as well. So if you are transferring the beneficial ownership, it doesn't matter. Legal ownership is very important. If you are holding the legal ownership, then it will be considered. Otherwise, it will not be considered. 95% threshold nominal issued or paid up capital that we have already discussed. Different nominal values. This example is very classical, by the way. It will give you a lot of clarification. Number of shares are 100. Nominal value per share is 10. The total share capital is total capital is 1000. Class 2 shares, one number of shares value is 1000 and total is So total value of the total capital is 2000. Out of this is my nominal value. This is my nominal value. This is the total value. These are the number of shares. Apparently, number of shares are 101, value is 1000. So company B hold 100% class 1 shares of company A. Okay. Formula basically 1000. What is the nominal value holding? 1000 divided by 2000. 50%. So company A is holding only 50%. If you are assessing based upon the number of shares, this 100 divided by 105, they are holding around 99% shares. But the value they are holding only 50%. This is the reason that basically we need to ascertain based upon the nominal value. And based upon the nominal value, they need to have at least 95%, but they are holding only 50%. So this company cannot be part of the tax group. So as I mentioned, number of shares held in company is weighted by the reference to the nominal value. The share capital ownership condition is not met because 1000 divided by 2000. If you are considering based upon the number of shares, 99% shares held by A, but 99% shares, but only 1000 nominal value A is holding. So company B, even though the company B holding 100% of the class 1 share, 99%, this is the same thing I mentioned. Right and voting rights, profit share, the each will determine reference to nominal value. We already discussed this one. Indirect ownership. This thing was basically very unusual for me, very honestly. I still I look into this, but it has been given in the guide. We need to stick to it. Law says the taxable person, the parent company is holding 95% shareholding directly or indirectly. Apparently, you will see A is holding 90% direct shareholding in B, A is holding 80% in C, and C is holding 10% in B. So if I am assuming 80% into 10%, it will be 8%, right? 80%, 80% and 10%. If I'm multiplying 80 into 10, it will be 8%. So apparently it looks like 90% plus 8%. It is total 98%. So A is looks like this. A is holding directly or indirectly 98% shares in B. Because 90% they are holding directly and 8% they are holding, no, sorry, 80% into 10. Yeah, 8%. So 90% they are holding directly and 8% they are holding indirectly. So apparently it looks like A is holding 98% shares of B. So A and B would have made a tax group, but in the law, sorry, in the guide, they said C is not a subsidiary of A. It doesn't been given in the law. C is not a subsidiary of A because A is not holding 95% in C. So this link has been broken here, and this is the reason that A is not holding the indirectly 8% in B. This is quite strange for me. Might be some more clarification will come, or otherwise we need to stick to it. You can go through this. This is the same thing they mentioned here as well. They said company A directly owns 90% of share capital in B. Agree. The indirect ownership in B can only be considered if held through one or more subsidiaries. And C is not a subsidiary of A. Quite strange for me, very honestly, but we need to stick to it. They're asking C is not a subsidiary of A. A is holding 80% in C, but law says C is not a, guide says C is not a subsidiary of A. The share owned by C cannot be considered in determining whether the share capital condition is met by A. So therefore, condition is not met in case of B as well. Condition is not met in case of B as well. I was initially thinking 90%, 8%, 98%, which is incorrect for me as well. We need to stick to it in case some more clarification is coming from the FD. They have repeated the same thing here as well. A is holding 95% in B and B is holding 95% in C. This is very correct, by the way. A and B can become a part of the tax group because A is holding 90%, 95% in B and B is holding 95%. If B is holding, if multiply 95 into 95, A will not be holding 95% in C, or C cannot become a part of the tax group. So this, that A can make a group A with B. Okay. So basically two group A can become a part with B, B can become a C, all cannot go into the same tax group. Two tax group can be set up, A and B, B and C. Okay. This is again, A is holding 95% in B, B is holding 50%, A is directly holding 50%, A is holding, it means A is holding 95 into 50. Then they are asking all these three entities can become a part of the tax group. In the transfer between the tax group members, initially B was holding 95% of D, now C is holding 95% of D. For A, it doesn't matter B is holding or C is holding. In both of the conditions, they said in this A is indirect ownership of 95%. Then in the second condition, A is indirect only 95%. Initially here it was from through the B, here it was through the C. In both of the conditions, A is holding 95% in D, so they can become a part of the tax group. And these conditions have been met continuously throughout the year. Transfer of share out of the group. If the shares are being transferred out of the group, we need to stick to this 95% of the nominal value of the share capital. If that condition is met, it's fine. If that condition is not met, then it will be assumed that the group is no more exist from the start of the respective tax period. Even if one company is leaving, the group will remain there. Two companies are leaving, group will remain there. If there was only two companies, one is leaving, selling the shares out of the group, then group will no more exist. We need to go through this in detail. So what apparently looks like, if one company leaving, share selling out of the group, and 95% condition is not met, that company will be considered out of the tax group from the start of the respective tax period. And this will be considered when the ownership of the share will be transferred. Voting rights, 95% voting rights. Now voting rights, this is bit different from the legal ownership of the shares. The voting rights based upon the memorandum document, one person can assign the voting rights to the other, even they are not holding the share. Apparently look like if one person is holding 95% share, the same person will have 95% of the voting rights as well. But there is a possibility that that person has given the voting rights through the memorandum to any other person. This person is holding 95% share, might be this person has the voting rights 95%. There is a possibility this person doesn't have the voting rights based upon this ownership, because through the memorandum or any other document, might be this person has given the voting rights to any other person. So this is the only important condition, is this voting rights can be delegated as well through the document. We need to look into this, who is holding the voting rights. And for to make the tax group, this is important that the parent company is holding at least 95% voting rights. Might be it will come through the nominal value of the shares, or might be it will come through the any other document, a memorandum or something. They mention a constituent documents of entity, any other shareholder agreement there can be there as well. It is not compulsory that the person must be holding 95% shares. They are having the 95% voting rights as well. They mention generally voting rights are tied up to the nominal value of the capital, but this is not compulsory. Voting rights can be delegated through the constituent documents of the entity or any shareholder agreement. Extraordinary voting right doesn't matter. We need to look into this, who is holding the 95% voting rights. Indirect holding rights, profit, and this is important again, profit and net assets. Some people are considering profit or net assets. No, this is and we need to stick. These are four conditions. These are not two conditions. These are four conditions: profits and net assets. So profit entitlement, net profit. They are asking if the profit has been transferred to the reserve. Profit has been transferred to the reserve, then still it will be assumed the person is met the parent company is meeting the 95% condition. It will be considered in the profit entitlement as well. So they have mentioned here Often distributed profit will be accumulated realized net profit based upon the applicable accounting standard. If certain profit are not available for distribution, such as those allocated to the non-distributed legal reserve, the shareholder can generally be considered to hold the right to such profits. So profits distributed, distributable, non-distributable. So basically we need to let the numbers before this. If the parent has entitlement on the profit before distribution or before allocation, it will be assumed we need to look into that profit. We should not look into the profit, what has been distributed, what has been transferred to the reserve. We need to look into the number before the allocation and before the distribution of the profits. Entitlement to at least 90% net assets entitlement, they said upon winding up of the subsidiary. If the subsidiary is being winded up, the person must be holding 95% in the net assets. Net assets, we know this, that net assets is equal to basically total assets less total liabilities. It will be equal to the equity value, which will be net assets. So several clauses, different conditions they mentioned here, that this is certain condition, this is profit distribution, profit not distributed. So again, the example is almost same, 100 into 10, 1000, 1 into 50, 50. So total nominal value is 1150. Nominal value condition is being met. Voting right condition, this is all a shareholder company, a preferred shareholder. This is one preferred shareholder, others are preferred shareholder. In 2024, basically they are asking 1000 divided by 1050, 2.8. Company reports profit of 3 million. If distributed, would be distributed 2.8 million company and 0.4 million to preferred shareholder. 3 million. The company should distribute the full profit of 24.1 million profit. It will be given to the preferred shareholder because this profit is it will be given to the preferred shareholder. In the ownership condition, the profit conditions are met. In 2025, profit condition is not met because profit is in 2025, the profit is 0.1 million. It has 100% gone to the preferred shareholder. So this company will not be getting, this company holding ordinary shares. Company C incorporated tax resident, share capital company C is as follows. So in they asking, in 2025 profit condition is not met, but in 2024 profit conditions and ownership condition has been met. Transfer of shares outside the group, we have already discussed. Basically, it will be considered upon the legal transfer and it will be applicable from the start of the respective tax period. Indirect holding of the rise to profit and net profits, exempt person conditions. So we discussed two things. First, we discussed a resident juridical person. Then we discussed 95% voting rights, share capital, entitlement in the profit, and fourth condition is sorry, what is the fourth condition? Entitlement in the profit, then 95% entitlement in the net assets. So we have discussed two conditions, and third one is not an exempt person, not a juridical person. We know what are the exempt person: government entities, government controlled entities, qualified. This is then extractive resources, non-extractive natural resources, qualifying benefit funds, statutory funds, pension funds. These all are the exempt persons. But then these exempt person cannot become a part of the tax group. But there is one exception to this. There is one government subsidiary which is meeting all other conditions. This government subsidiary can become a part of the tax group. There is one exception to this for the exempt person. Branches, they said, cannot be, branch of a non-resident person cannot become a part of the tax group. We have already discussed in the very beginning two conditions. Resident branch will be assumed this is the PE of the non-resident person, and this branch doesn't have any legal importance. Basically, this is extension of the main entity. So itself branch has no legal importance. This is not separate from the main parent company. Branch is the extension of the parent company. So branch cannot become a part of a tax group. Moreover, we have discussed in the very beginning the resident juridical person. Branch is a PE of the non-resident person, so cannot become a part of the tax group. Government entry exception, we have discussed. Small business relief, if we are considering small business relief, we know the small business relief, the taxable turnover, sorry, no. For the small business relief, the loss is basically the revenue in the current tax period and in any previous tax period is below 3 million or up to 3 million, then the person can avail small business relief. And this would be applicable up to the end of year 2026. After that, we need to look into what will be the terms and conditions. So this small business leave will be applicable on overall group. This will not be applicable on the respective individual entity. So this clause of small business leave is applicable on the overall at group level. They said by three entities, one A, B, C, overall revenue is 3.5 million. They are part of a tax group. They cannot enjoy the small business leave because the revenue is more than 3.5 million. Financial year condition. So financial year condition. Financial year condition, we said all the potential group members or existing group members must have the same financial years. So if they have different financial year, they cannot become a part of the tax group. So this financial year can be changed. It can be extended up to 18 months. It can be reduced up to 6 months. They can align the financial years to form a tax group. So this is the financial year condition. You can go through this description. Newly establishment member, it can, the time the company will be incorporated, it will be assumed it will become a part of the tax group from the date of the incorporation. Existing members, it will be assumed that it will be considered part of the tax group from the start of the respective tax period. You can go through this detail. This example, you can go through this. Basically, two companies are A is holding B. A is financially 31st December, B is 31st August. Either E needs to align, change the financial year, or B needs to change the financial year. Both needs to be ending on the same date. Then they become part of a tax group. Otherwise, they cannot part of a tax group. They mention the same thing over here as well. A changes its financial year to 31st August and consequently changes the tax period with the approval of the FTA, or to keep it 1st September, or alternatively, company B could change the financial year. Either E needs to change or B needs to change with the approval of the FTA. Both needs to have the same financial year. If they have the same financial year, they can become a part of the tax group if all other conditions are being fulfilled. Accounting standard conditions. All the respective members of the tax group, they are applying the same or uniform accounting standards. When I'm asking same or accounting standard, they might be applying cash basis, accrual basis, full-fledged of IFRS or IFRS for SMEs, whatever they're applying, cash, accrual, full-fledged, because in the accrual full-fledged will come or IFRS for SMEs will come. Whatever the method they are applying, they must be applying uniform across the group. Everybody would be following the same. If one company is applying full-fledged, all other companies will be applying full-fledged IFRS. If one company is applying IFRS for SMEs, all other companies must be applying IFRS for SMEs. If one company is applying cash basis, all other companies must be following the cash basis of accounting. So this is the condition. Basically, all these conditions needs to be met. There, I have added one word here. Yeah, this one basically. This is important here, which I added. IFRS to IFRS, IFRS to IFRS for SMEs, not allowed. Apple to Apple comparison, you cannot say one company is preparing IFRS, second is doing IFRS for SMEs. This is not allowed. It has been mentioned here. One juridical person uses IFRS, another juridical person uses IFRS for SMEs. If one juridical person preparing financial statement based on IFRS for SMEs want to join a tax group whose members are preparing financial statement based upon IFRS, that juridical person would need to prepare his financial statement based upon the IFRS. Apple to Apple comparison, this is a very straightforward thing. Okay, in the guide, in the explanation, qualifying free zone person cannot become a part of a tax group as well. We know what is a qualifying free zone person. Qualifying free zone person is the person registered within the free zone. All 6 conditions are being met, enjoying 0% corporate tax relief basically on the qualifying income. That person cannot become a part of a tax group as well. So we have discussed the conditions to form a tax group today. In our coming lecture, coming webinar, we will be discussing, we'll try to complete rest of the all areas in our coming webinar. So if you have any question, you are most welcome. This is over from my side. You are asking to be subsidiary as per CAT, you should hold 95%. Then we look for indirect ownership in other company. FTA guide is clear. FTA guide is not clear, my friend, very honestly. The reason is FTA in the law it has been written that, okay, one company, if you are holding in other company more than 50%, this is a subsidiary. If you are holding, okay, let me go through subsidiary definition. Might be they have defined in the subsidiary definition as well. If they have given subsidiary means 95% shareholder, then you are correct. subsidiary. If it is been defined in the law that the subsidiary means 95% shareholding at least, then you are right. PQRS. PQRS. Subsidiary. A resident person that can make an application to the FTA to form a tax group with a parent company in accordance with the article. Okay, they're not all basically, okay, let me go through the law. Might be they have defined in the law. Okay, I'll go through this later on. Okay. But I believe if they are defined somewhere subsidiary means 95% shareholding, then this is correct. I was assuming subsidiary means as per the IFRS, which is more than 50%. And in other words, indirect ownership is making more than 90%, 95%. Anyway, we need to look into this area. Second is if SME is it allowable to transfer profit to next financial year? In SME, is it allowable to transfer profit to next financial year? In SMEs, is it allowable to transfer profits to next financial year? No, you can transfer the losses, you cannot transfer profits. On the profit, you will be liable to pay the tax. Losses you can carry forward for unlimited period of time. Any other question? If you have any question, you are most welcome. No more question? Okay, Faiza, thank you very much. Thank you very much, guys. Have a lovely evening. Good day. Thank you.
Thank you, everyone.
But SME is no tax is payable. For SMEs, no tax is payable. Yeah, for SMEs, the tax is basically if you are taxable profits, tax will not be payable. You will not be able to carry forward the profits. Profits basically, there's no option to carry forward the profits. They are asked one more question. You can carry forward the losses. Anyway, thank you very much. And if you have any specific question, you can drop us an email. You can give us a call as well. And it will be player supporting you. Thank you very much, Faiza. Thank you, everyone. Have a good day. Thank you.
Thank you,
Bye-bye.
everyone.
Thank you.
Bye.
Bye-bye.